Fed raises rates by way of 0.75% as rampant inflation forces biggest hike since 1994. The Federal Reserve surprised markets on Wednesday with a bigger than expected 0.75% rate boom as constantly high inflation pressured the principal financial institution to deliver its biggest hike at a single meeting due to the fact that 1994. The Federal Open Market Committee raised its benchmark rate to various 1.5% to 1.75% from 0.75% to 1% formerly. That turned into extra hawkish than economists' expectancies for a 0.5% price hike. In the weeks main up to the selection, Fed Chairman Jerome Powell said he wasn't actively considering a 0.75% rate increase and signaled that a 0.5% hike might be appropriate on the June and July conferences. But several symptoms showing above-trend inflation may want to stick round for longer than feared compelled the important financial institution to step up the pace of financial policy tightening to save you falling further at the back of within the war towards inflation. The Fed now sees its benchmark rate growing to a few 4% in 2022, markedly above the 1.9% forecast in March. With 4 conferences remaining on the Fed's calendar, in addition 0.75% charge hike is possibly. From the attitude of nowadays, either a 50 basis factor or a 75 foundation factor boom appears maximum probably at our next assembly, Powell stated in the press convention that followed the policy decision on Wednesday. The Fed chairman, additionally signaled that the significant financial institution changed into eager to front-load or supply huge hikes now, potentially paving the way for a slowdown later. We got here to the view that we'd like to do a little more front-end loading. Today's 75 basis point boom is an surprisingly large one, and I do not assume movements of this length to be not unusual, Powell added. The steeper-than-predicted fee hike pushes the Fed closer to accomplishing the impartial price a charge that neither improves the economic system nor slows it down. The Fed had previously signaled that it became keen to move expeditiously to a restrictive stance above the neutral price to bring down demand and funky inflation. Inflation, meanwhile, isn't expected to attain the Fed's 2% target every time soon. The core private consumption prices rate index, the Fed's favored inflation, is forecast to climb to 4.3% in 2022, up from a prior forecast of 4.1%. For 2023, inflation is expected to drop to 2.7%, as compared with the earlier forecast of 2.6%, while in 2024 inflation expectancies are unchanged at 2.3%. Restoring supply and call for within the hard work marketplace is key to the critical bank's plans. A tight hard work marketplace wherein there are about 2 jobs for every unemployed American threatens to gas a salary spiral that would push inflation past the Fed's reach. Some on Wall Street have counseled that process profits might ought to reverse earlier than the Fed considers taking a step back. No, a laugh, till the Fed is achieved, and in 2022 that calls for a poor payroll print, Bank of America said last week. The Fed is having a bet that its policy will assist carry a few balance to the labor marketplace, with members now seeing the unemployment charge at 3.7% at year-end, up barely from a previous forecast of 3.5%. The era of aggressive Fed tightening has many concerned that the significant bank ought to overshoot on policy tightening, slowing the economic system via an excessive amount of into recession. Despite cutting their increase outlook, Fed members continue to wager that a recession could be avoided, forecasting the financial system to develop 1.7% in 2022, down sharply from a previous forecast of 2.8%. Still, fears of a recession have been most commonplace within the bond market, in which the yield curve maintains to flatten, a sign that bond buyers appear to be losing self-belief within the Fed's capacity to avoid a difficult landing. The Fed's plan to reduce its nearly $9 trillion balance sheet got underway on Wednesday, as the first tranche of debt, or Treasury securities, matured. The quantitative tightening plan will to start with permit $30 billion in Treasury securities and $17.5 billion in agency MBS to roll off its stability sheet, with the purpose of step-by-step stepping up the pace after 3 months to $60 billion and $35 billion in step with month, respectively.